Hello everyone. In today's video, we will be working through Chapter 3, which is titled Working with Financial Statements. So what we'll be dealing with today is looking at those balance sheets and income statements that we discussed in Chapter 2 and identifying what information can I take from these financial statements in order to evaluate the financial health of the companies that we are looking at. So once again, Chapter 3 will be broken down into two separate videos. Part 1 here today will cover the conceptual material from Chapter 3, and then similar to Chapter 2's lecture videos, the second video here in Chapter 3 will be me working through some practice problems. So, what are our learning objectives for Chapter 3? First of all, be able to standardize financial statements for comparison purposes. And then we'll compute, and this is a very point that needs to be made. More importantly, be able to interpret some common ratios. So a ratio is simply one value divided by another. It's not a difficult calculation. What's most important is that we are able to interpret some of these common ratios. What are they actually showcasing, and why is that important? Then we'll be able to name the determinants of a firm's profitability. And lastly, explain some of the problems and pitfalls in financial statement analysis. So to begin, the first thing that we will be doing here is standardizing financial statements. So oftentimes it is very difficult to compare two companies. It's almost impossible to directly compare the financial statements of two companies simply based because of the different sizes of the companies that you are evaluating. So just looking strictly at a balance sheet and an income statement for two companies, it's hard to make a comparison due to the different sizes of the companies you're evaluating. So for example, let's say you were trying to evaluate the financial health of Pizza Hut versus Avalanche Pizza down here in Athens. Very difficult, different size, different cost structures. So what is one way that I can actually evaluate two companies of these different sizes? And the one way that we can do so is by standardizing their financial statements. So what are we calculating, or what are we creating here? What we are creating by standardizing financial statements is we are going to create what is called a common size statement. A common size statement is a standardized financial statement presenting all items in percentage terms. So no longer are we dealing with actual numeric values. Now everything will be listed as some percentage. A standardized financial statement makes it easier to compare financial information, particularly as the company grows. And they are also useful for comparing companies of different sizes, particularly within the same industry. So now we are coming up with a way that we can actually evaluate the financial health of one company versus another without having to consider exactly what those different size differences are of the two companies being evaluated. So the first type of standardized financial statement is what is called a common size balance sheet. With a common size balance sheet, what we will be doing is taking every item on the balance sheet and we standardize it by dividing by total assets. So why are liabilities and stockholders' equity, the right-hand side of our balance sheet, also divided by total assets? That's because that's due to the balance sheet identity. Remember, the balance sheet identity says that total assets equals total liabilities plus total stockholders' equity. We take everything on the left-hand side and divide it by total assets, and since the right-hand side equals the same thing, we take the entire right-hand side and divide it by total assets as well. So now all of the account values are represented as a percentage of total assets. We no longer have actual numeric values. Now we have percentages of total assets. The analysis is rather straightforward. We should know that all of the percentages add up to 100%. But here is an example of a common size balance sheet. As you can see here, now everything is listed as a percentage. So cash in 2017 represented 2.5% of their total assets. Accounts receivable accounted for 4.9% of their total assets, and you guys can see so forth. But what is nice about these common size statements is that what you are now able to do is compare a company's performance not only against main competition or competitors that are of different sizes, but we can also compare a company's position or their balance sheet from one year to the next. So let's just do a quick little breakdown of this hypothetical Prufrock Corporation from 2017 to 2018 and just point out some key pieces that can help in our analysis. So first of all, I'm looking at cash, accounts receivables, inventory, their current assets. What we can see is that their current assets actually increased. So it increased by 1.8% of their total assets from 2017 to 2018. If I go down to the liability side, we can also see then that their current liabilities actually decreased by 1.2%. as a percentage of their total assets. So we have current assets increasing, current liabilities decreasing, again, all relative as a percentage of their total asset investment. But if their current assets are increasing and their current liabilities are decreasing, we can say that this company has become more liquid. So they are better able to cover their short-term liabilities with their short-term assets, those assets that are most liquid, the most easy to be able to convert to cash without a loss in value. Another thing that we can point out here is that their long-term debt actually decreased. In Chapter 2, we talked about as a company increases the amount of long-term debt that they use to fund their asset purchases, we say that they are using more leverage. So in this case, with this company actually decreasing their amount of long-term debt, they are actually less leveraged. So they have actually changed their capital structure. Primarily, they're spending more, they're funding more of their asset purchases with stockholders' equity, specifically retained earnings. So they're growing organically or growing from within. So one thing that you could look at here from 2017 to 2018 in this company is that their liquidity has increased, their capital structure has changed, they've become less leveraged, and you may conclude then that the balance sheet has actually grown stronger from 2017 to 2018. So that is our first type of analysis. It is a common size balance sheet. It is a standardized financial statement where all of your values are now listed as percentages rather than numeric values. The second type of common size statement is what is called a common size income statement. With a common size income statement, each income statement item is now standardized by dividing by the dollar amount of net sales. So remember, net sales is your top line figure, also referred to as revenues. And now each income statement item is indicated as a percentage of sales. And this common size income statement can tell you a lot about a firm's efficiency and their profitability. So you start off with your top line figure, your sales, and what items on your income statement are impacting your bottom line the most. Remember from Chapter 2, your bottom line is your net income. That is the profit that can either be distributed to shareholders in the form of a dividend or put back into the company to grow organically. So this common size income statement can identify what expenses are impacting our bottom line the most. So here is an example of a common size income statement. Since everything is going to be divided by sales, your top line obviously is going to be 100% because it's just sales. That's where our starting point is. Now, for each dollar of sales, they're losing 58.2 cents in cost of goods sold, and you can just work your way down and see what percentages or what expenses are taking away from your net income, your bottom line, the most. So looking at it from one year to the next, you can identify which categories or which expenses are impacting your bottom line the most. So moving forward, those are our common size statements. Another way that we can actually analyze two companies of different sizes is by looking at ratios. So we next turn our attention to ratio analysis. So once again, this allows for better comparison through time or between companies, so you can evaluate a company against themselves year over year or evaluate a company against their main competitors within the same industry. And these ratios are used both internally by management and also externally by an example would be like creditors or investors could use these to analyze a company's financial standing. But what's key, as I mentioned at the start of today's video, is that a ratio is not really telling us anything by itself. It's just one number divided by another. So for each ratio, you have to ask yourself, what is this ratio trying to measure? And then why is that information important? Okay, so it's not just the ability to look at a value or look at a financial statement and compute a ratio. It's more important that we understand what that ratio is actually showcasing and also why is it important in terms of our evaluation. So there are 5 different categories of financial ratios that we will be covering, and I'll go into detail on each different ratio after I discuss what the categories are. The first category are called short-term solvency or liquidity ratios. So solvency simply means your ability to pay debts when they are due. So what is your ability to meet your short-term obligations, your current liabilities, with your short-term assets, your current assets? So that's what short-term solvency ratios look at, is what is your ability to cover your short-term obligations with your short-term assets. The second category are called long-term solvency. So once again, solvency is the ability to pay debts when they are due. This one focuses on your long-term obligations, so your long-term debt. These are also called financial leverage ratios because we have already discussed that the term leverage refers to the amount of debt in your capital structure. So long-term solvency or financial leverage ratios deal with the amount of debt that is used to finance the firm's assets. You also have asset management or asset turnover ratios. These are also called asset efficiency ratios. And these ratios focus primarily on are your assets translating into sales, your top line on your income statement. Then we have profitability ratios. Profitability ratios then focus on profit, which is your net income. And then the fifth category are market value ratios. So that combines market information, primarily dealing with your stock price, that's your market value, and the market's perception on these four other categories or these four other areas of financial analysis. So the first thing that we will be talking about before we even get into our ratios and what each ratio is showcasing is benchmarking. What is benchmarking? So without actually comparing the ratios to something, the numbers are irrelevant. So what we need to do is we need to benchmark these ratios against something. So the ratios need to be compared to something. One example I always give is I'm a big sports fan, so I say player A is shooting 75% from the free throw line. And you can ask yourself, is that good or bad? Well, it all depends. If it's Steph Curry shooting 75%, that's bad. He's a 95% free throw shooter historically. But if it's Shaquille O'Neal, who was a historically poor free throw shooter, a 50% average or so, then that would be a good percentage, that 75%. So what the key from that example is I need to be able to compare the ratio to something in order for it to have some type of value. So what are some different things that I can compare the ratios to? First would be a time trend analysis. Just like the phrase says, with time, we are comparing ratios over some period of time. So how is the firm's performance changing through time? And it has, again, internal and external uses, so you can evaluate a company's financial statements using these ratios and looking at increases or decreases in specific ratios to evaluate efficiency, profitability, etc. And then another type of benchmarking is what is called a peer group analysis. So what you're doing with a peer group analysis is you are identifying firms in similar markets, they have similar assets, and they operate in similar ways, similar size. How do I know what a company's similar or competitors are? Well, there are two different codes that companies are provided. One is the Standard Industrial Classification Code, the SIC code, and then you also have the NAICS code, the North American Industry Classification System. So basically what these do is they group peers within the same industries together, so you are better able to analyze companies within the same industry and similar or main competitors. So those are our benchmarking strategies, either comparing a company against themselves or comparing companies against their main competitors operating in the same industry. These ratio values can fluctuate can fluctuate drastically depending on what industry you operate in. So it is important that you're trying to compare and have an apples to apples comparison. So you want to compare companies that operate within the same industry when you're doing this ratio analysis. Okay, so the first category of ratios is liquidity ratios. As we mentioned previously, these liquidity ratios measure the ability of the firm to meet their short-term obligations, so your current liabilities, with your short-term assets, your current assets, without endangering the firm. So there are three commonly used ratios. They are called the current ratio, the quick ratio, and the cash ratio. Now, I will provide a handout with all the different ratios that we cover in this particular chapter. It'll be posted on Blackboard, but you may also want to take notes on what these different ratios are actually showcasing. So what I will do is I'll give you a handout that has the actual ratio. What you need to focus on then is what is the ratio actually showcasing. So why is it important? The first one is the current ratio. The current ratio is current assets divided by current liabilities. So how many dollars of current assets do you have per dollar of current liabilities? Or the other way that you can evaluate the current ratio is how many times can I cover my short-term obligations, my current liabilities, with my short-term assets, your current assets, those assets that are most easily converted to cash. Very similar to our net working capital equation from Chapter 2, which was current assets minus current liabilities. In this case, instead of subtracting the two values, we are now dividing them. So once again, if a company has a positive net working capital, then we know that their current ratio is also going to be greater than 1. So they have current assets that exceed their current liabilities. Now, when you are evaluating the current ratio, the higher the ratio, typically the better. However, you also want to be cautious, because if it's too high, it may mean that you are investing too much of your cash, or you may be having an inefficient use of cash or other short-term assets. So understanding that your current assets are your least profitable, they generate the least amount of cash flow for a company in comparison to their fixed assets. So maybe you have a poor investment in your current assets, and you could distribute those funds elsewhere to become more profitable. Second type of liquidity ratio is the quick ratio. As you can see, very similar to the current ratio, except you take out your least liquid current asset, which is inventory. When I say least liquid, that simply means that asset that is most difficult to convert to cash without a loss in value. So remember what the term liquidity means from chapter 2. And then we also have simply the cash ratio. So the cash ratio is just simply cash. What is your cash balance divided by your current liabilities? So what amount of current liabilities are covered with cash? So liquidity ratios are oftentimes looked at by creditors to identify, is this company a company that is sitting in good financial standing? Are they able to cover their obligations when they come due? Would they be a company that we'd be willing to loan funds to? These are different questions that a creditor may, or different things that a creditor thinks about as they're going through this ratio analysis. So those are your liquidity ratios, your short-term obligations. The second category of ratios deal with your leverage ratios. These are your long-term leverage or your long-term debt ratios. So again, financial leverage refers to the use of long-term debt in a firm's capital structure. So the more debt, the higher your degree of financial leverage. Now, leverage can be twofold. It magnifies gains, but it also magnifies losses. So during good times, this will increase the returns to stockholders. They have more funds available, and they have a fixed interest that they're paying on these funds. And so during good times, they get to deduct those interest payments on their income statement, and it ends up actually increasing returns. But a negative would be that it actually it ends up decreasing returns in bad times due to that fixed interest payment. Now, these ratios are intended to address the firm's long-term ability to meet its obligations, or more generally, its financial leverage. And there are two sets of ratios that can analyze leverage. The first set are called debt ratios. So these actually quantify the use of debt in the capital structure, so how much debt is being used to fund their assets. The second category of ratios, or the second subset, would be coverage ratios. What is the company's ability to meet their debt obligations? So focusing on those interest payments that they have to make. So the first one that we will cover here deals with this first subset, which is debt ratios, quantifying the amount of debt. So what is the extent to which the firm finances its assets through sources other than stockholders, their debt? And it's called the total debt ratio. Remember that debt and liabilities mean the same thing. So the total debt ratio is calculated actually using both short-term and long-term debt. So this is your total debt, both short and long-term obligations, and the equation is simply total debt divided by total assets. So once again, what percentage of your assets are being funded by debt? This will help tell you what the company's capital structure is. Think back to chapter 1, your breakdown of debt versus equity and funding your asset purchases. But this is what the total debt ratio is. Sometimes, instead of seeing total debt, you may see total assets minus total equity in the equation instead. Remember, that's just your balance sheet identity. Total assets equal total debt plus total stockholders' equity. So to take the difference between assets and equity would give you your total debt. So once again, what proportion of the firm's assets are financed with debt? The higher the amount of debt, the higher the firm's leverage, and we say it's more risky. Why? Because they have those fixed debt obligations, those interest payments that they must make. So in the event of a downturn, they still have to make those payments, and so they are the more debt used, the higher the risk. Additionally, there are two variations of the total debt ratio. The next one being your debt to equity, which is simply total debt divided by total equity. So what is the amount of debt per dollar of equity? Once again, the higher this value becomes, that means you're having more debt fund your asset purchases, you're more leveraged, meaning that you are a riskier company, or that your company has higher risk due to the amount of debt that you're using. And then the last one is the equity multiplier. So the equity multiplier is, sometimes you'll just see as EM. Total assets divided by total equity. So what is the amount of assets per dollar of equity? So let me ask you a question. Company A has an equity multiplier of 2. Company 2 has an equity multiplier of, or Company A has an equity multiplier of 2, Company B has an equity multiplier of 3. Which one is more leveraged? Well, if we were to just put both of these over 1, and we know that the balance sheet identity always balances, in Company A, they have 1 unit of debt. In Company B, they have 2 units of debt, the difference between 3 and 1. So which one is more leveraged? It would be Company B. The higher the equity multiplier, the more leveraged, and so they're using more debt to fund their asset purchases. Now, all 3 of these are essentially showcasing the same thing. They're all saying how much debt is a company using in their capital structure. So what's nice about these leverage ratios is that once you know one of the 3, you can use the following relationships to solve for either of the other 2. So if I know the total debt ratio, or if I know the debt to equity ratio or the equity multiplier, I can solve for either of the other 2 ratios by using the following relationships. One being the total debt ratio equals your debt to equity divided by 1 plus your debt to equity. So if I'm given debt to equity, I can very easily plug it into this equation and solve for the total debt ratio. And then I also know that the equity multiplier, the other relationship is that the equity multiplier equals 1 plus your debt to equity ratio. So I'm not showcasing to you how these equations are actually, how these relationships come about. There's a whole algebraic way of how these are set up. What's key is that you understand, because you will utilize these relationships, is that if I know one of the 3 debt ratios, either total debt, debt to equity, or the equity multiplier, I can solve for any of the other 2 by using these relationships. So I guess the key takeaway here before moving on is that we understand that there are 3 debt ratios, the total debt, debt to equity, and equity multiplier, which quantify the amount of debt in a company's capital structure, how much debt are they using to fund their assets. And if I know one, then I can solve for either of the other 2 by using these relationships here. So again, all 3 ratios simply measure the same thing, how a firm's, they measure the firm's financial leverage. They just showcase it in different ways. One is a comparison between debt and equity, one is a comparison between assets and equity, and then the other one is just a debt to assets relationship. So those are your total debt, or your quantifications of the debt in the capital structure. The second subset of leverage ratios deal with coverage ratios. So coverage ratios deal with the company's ability to meet their obligations, so be able to pay that interest expense. And the first one is the times interest earned ratio, or sometimes just the TIE ratio. And it is your EBIT divided by your interest expense. EBIT is your operating income. So sales minus costs minus depreciation. And so that is your ability, or the company's ability, to actually repay their interest payments from their operating income. So how easy is it for this company to cover its debt payments out of its earnings or its cash flows? So the higher this coverage, the less chance of default, the better the ability to actually meet your interest expense. The last one then is the last coverage ratio is called a cash coverage ratio, and it measures the amount of cash a firm has to meet its interest payment. So same EBIT, your operating income, earnings before interest and taxes, but then we add back in that non-cash expense of depreciation. So what is the company's ability to cover their interest expense when you just take sales minus costs? What is their ability to cover that interest expense with that cash flow? Obviously, the higher the value, the better your ability, the less risky you would be from an analysis point of view. So the third category of ratios are called asset management ratios, or asset efficiency ratios. So once again, sometimes called asset turnover or asset rate or asset efficiency ratios, and they measure how efficiently the firm's management uses their assets to generate sales. That's a key point here. So asset management or asset efficiency ratios focus on assets translating into sales, your top line on your income statement. It's very important that you make note of that now. These focus on translation into sales. Primarily, the assets that they focus on then deal with inventory, accounts receivables, and then the use of fixed and total assets. So the first asset management ratio is the inventory turnover ratio, which is cost of goods sold divided by inventory. So we know that cost of goods sold is on your income statement, inventory is on your balance sheet. The inventory turnover ratio is combining both of our financial statements. So the way that you look at the inventory turnover ratio is you sell or turn over your inventory how many times over the course of the year. Okay, so your inventory balance is on your inventory amount is taken from your balance sheet. So it's a snapshot at this point in time when that balance sheet is constructed of how much inventory the company has on hand. Cost of goods sold comes from your income statement, which is over some period of time. So essentially it says how many times do I take an inventory balance of, let's say on the balance sheet it says 100. Once I sell through that, that goes to your cost of goods sold. They replenish the inventory up to 100 and they add to it, or once they go through it, that value goes to your cost of goods sold and so forth. So how many times do I turn over this inventory and translating into sales, which is then listed as a cost of goods sold item on our income statement. So the more often a firm can turn over the inventory, the better. And too high of a number or too low of a number could be a warning sign. If it's overall too high, it could mean that they are actually losing sales, so maybe they don't have enough inventory. Or if it's too low, maybe they have too much inventory. But overall, a high inventory turnover ratio is good. It's one of those things that you need to have some type of benchmark to compare it to, whether it be previous years or your main competitors, to identify is the company efficiently handling their inventory balance to translate into sales. And then if you want to know how long it's taking a company to turn over their inventory, you take 365 and divide it by that inventory turnover value. So how long is it taking you to turn over your inventory? Now, this is one of those ratios that is very industry dependent. So, for example, if you were evaluating, say, McDonald's with perishable goods, they may turn over their inventory multiple times, hundreds of times over the course of the year, and their day sales and inventory may be only a couple of days. Whereas if you're looking at an Apple or something, their days sales and inventory would be substantially different because they have different products, different inventory. Okay, so those are asset management ratios. They're the first type of asset management ratio, and it's dealing with inventory. The second asset management ratio focuses on accounts receivables, so your credit sales. So accounts receivable turnover is net sales divided by accounts receivable. Sometimes you'll see this if you have the information as just credit sales. So how many times are you collecting on an amount that's equal to your accounts receivable balance from your balance sheet and converting that to an actual cash flow, which is then located on your income statement as a sale. So how quickly are you collecting on your credit sales? And similar to the inventory turnover, accounts receivable turnover can also tell you how many days it takes you to convert a credit sale to to collect on a credit or on your accounts receivable, and that is days sales outstanding. So 365 divided by your accounts receivable turnover. Sometimes it's called your average collection period, but it's essentially saying what is the number of days that it takes the firm to convert these receivables into cash. So the fewer the days, the more efficient the firm. So the next type of asset management or asset efficiency ratio is the total asset turnover. So TAT, sometimes you'll see. Total asset turnover is simply sales divided by total assets. So what is the company's ability to generate sales? Actually, from their total asset investment, we can say the company has this many dollars of sales per dollar of assets. So the higher the total asset turnover, the more efficiently the assets are translating into sales. So the higher the turnover, the more efficiently the management is utilizing their total assets. There is also a capital intensity ratio. As you can see, it's just a reciprocal of the total asset turnover. So what amount of assets do you need to invest to generate $1 in sales? So high values in your capital intensity ratio correspond to capital intensive industries. One thing to keep in mind when you're looking at the total asset turnover ratio in particular, I'm back up here to this first one, is that remember that sales is from your income statement and assets are from your balance sheet. Assets are depreciated each year. So if you have a high total asset turnover, it might not be that good if the assets are old and fully depreciated on the books, meaning that you're going to have to make an additional investment in fixed assets here at some point. But then on the other side of that coin, if it's too low, if maybe your total asset turnover takes a substantial drop in from one period to the next, maybe that's not necessarily a negative sign. Maybe it's just a situation where they just made a new investment in fixed assets, so they have a higher value on their balance sheet than what they did in the previous period. So again, these ratios can showcase areas of concern or areas of efficiency or inefficiency, but the ratio values by themselves don't tell the whole story. All they do is identify an area that would need further analysis by an investor or by any individual that's conducting this ratio analysis. The fourth category of ratios, as we mentioned, were profitability ratios. Asset efficiency ratios focus on sales, assets translating into sales. Profitability ratios focus just on its name. They focus on profit. So what is the overall effectiveness of the firm's management? And they focus on the profit, which is your net income, the bottom line from your or on your income statement. So these measure your financial performance. These ratios are probably the value or the ratios that you are most familiar with, but they really focus on a company generating profit, which is your net income. The first one is called your net profit margin, or sometimes just referred to as your profit margin, and it is net income divided by sales. So how much net profit is being generated from each dollar of sales? So you start off at sales, how much remains in the form of profit after all other expenses have been taken out? Additionally, we also have return on assets. So profit margin really focuses on profit as a percentage of shares, but shareholders also really want to know what type of ROA is the company generating and what type of, and there's another one that we'll cover here shortly. But ROA, your return on assets, is how much profit or net income is being generated from your asset investment. And then another very common one is return on equity, which is how much profit is being generated on your equity investment. So it measures your net income as a percentage of the stockholder's investment. So since we said in Chapter 1 the goal of financial management is to maximize shareholders' wealth, from an accounting point of view, so using book values, ROE is that true line, that true bottom line measure of performance for the company. So how much profit are they generating on their equity investment? So there's one or two relationships that I need to point out here between ROE and ROA. Anytime a company does not utilize debt in their capital structure, so no liabilities, if you think back to your balance sheet identity, which says total assets equal total liabilities plus total stockholders' equity, if they have no liabilities, their total assets equal their total equity, so ROE would equal ROA. As soon as a company introduces some form of liabilities, a company's ROE will always be greater than ROA. So you always know that a company is utilizing debt if their ROE is greater than their ROA, and that's strictly due to the way that the equations are set up and our balance sheet identity. So the last category of ratios are your market value ratios. Market value ratios reveal how the market views a company's liquidity, efficiency, leverage, and profitability, so the four previously mentioned categories. The first market value ratio is earnings per share. This measures income after taxes generated by the firm for each share outstanding. So income after taxes is simply your net income. And so you take net income and divide it by the number of shares outstanding. So what is the earnings, what is the profit, what is the net income per share that's outstanding? We also have the price to earnings ratio, which is called the PE ratio. So the price per share divided by the earnings per share. And it's how much are investors willing to pay per dollar of earnings of the firm. So the higher the PE ratio, investors are willing to pay more per dollar of earnings for the firm. Why would they be willing to pay more? Well, the PE ratio can be seen as a means to look at the prospects of future growth. So if you're willing to pay more per share, or if you're willing to pay more per dollar of earnings for the firm, you would expect that company is going to grow, and that's why you're willing to pay more for that share versus another share with a lower PE ratio. So the price to earnings ratio is an indicator of investors' attitudes towards prospects of the firm and of the firm's risk. So you're willing to pay more if you expect that company to grow. However, what if a company doesn't have earnings? So let's say they're a startup company and maybe they have negative earnings in their first couple of years. Is the PE ratio even meaningful? No. So there is a variation to the PE ratio, which is the price to sales ratio. So even though the company may have negative earnings, primarily due to, let's say you're a startup, for example, they will still probably have sales. So a useful variation is the price to sales ratio. So what is the price per share divided by the sales per share? So once again, this is all relative to what industry you're in. Sales per share is simply net sales divided by the number of shares outstanding. So the last one was earnings per share, so net income divided by shares outstanding. Sales per share is simply net sales divided by shares outstanding. And the last market value ratio is the market to book value, which is your market value per share. So what is the share actually trading for, divided by the book value per share. So book value per share is total equity minus preferred stock divided by the number of shares outstanding. And essentially it's a way of measuring the relative value of a company compared to its stock price. So what it can do is help identify if a company is overvalued or undervalued. Typically it's compared to a value of 1. So if it's under 1, it may be that it's undervalued, where the market value is not actually showcasing what the book values are showcasing. Over 1 could mean that it's overvalued, but it's another way that you can evaluate a company's stock. So those are the 5 categories of ratios in the equations, or in the different types of ratios within. Hopefully we have an understanding of what each of those ratios is actually showcasing. We next turn our discussion to another way of analysis, and it's called the DuPont System, or the DuPont identity. So once again, this is something that's always true. And the DuPont system, or the DuPont identity, a quick overview, it is a set of related ratios that once again links the balance sheet and the income statement. And it is used as a diagnostic tool to evaluate a firm's financial health. And both management and shareholders can use this tool to understand the factors that drive a firm's ROE. So the DuPont system, or the DuPont identity, focuses on what are the main determinants in a company's ROE. Why is a company's ROE increasing, decreasing? Why is it this value in comparison to its competitors? But it focuses on evaluating the main drivers of a company's ROE. And it's based on 2 equations that relate a firm's ROA and its ROE. So the first step of the ROE equation, or the DuPont identity, is what we do is we take return on equity. The equation is net income divided by total equity, and we multiply both the top and bottom by the same value, which in this case is assets. And what we can do is, if you know from previous math courses that if you multiply both the top and bottom of a fraction by the same value, it doesn't change the overall value of that fraction. And we also know from our basic math principles that a times b is the same thing as b times a. So what I can do is rearrange this equation and see that ROE can actually be broken down. I'll move assets over here, I'll move total equity over here, and I can break down ROE to net income divided by total assets multiplied by total assets divided by total equity. I have not changed the value of the overall fraction, I've just rearranged its inputs. Now these 2 equations should not look foreign to you. What is net income divided by total assets? That is simply ROA. And what is total assets divided by total equity? That is your equity multiplier. So ROA was one of our profitability ratios. Equity multiplier was one of our leverage ratios. So we can see that the first step in the DuPont identity showcases that return on equity is determined by a firm's ROA, so their profitability using their assets, and its use of leverage. That's what the equity multiplier showcases. How much debt are they using in their capital structure? So a firm with a small ROA can actually magnify their ROE by using a higher leverage, so using more debt in their capital structure. That is just step 1 of the DuPont. The next step is to take that ROA equation, which we know is net income divided by total assets, and once again I'm going to multiply the top and bottom by the same thing. I'm going to rearrange it. I'm going to move total assets underneath net sales, move net sales underneath net income, and we can see then that ROA is broken down into net income divided by net sales multiplied by net sales over total assets. Once again, these are not new equations or new ratios. Net income over net sales is simply your profit margin. And then net sales divided by total assets is your total asset turnover. So net profit margin is one of our profitability ratios. Total asset turnover is one of our asset efficiency ratios. And so what we've been able to do is take that ROA portion of the DuPont and break it down into the product of profit margin and total asset turnover. Now, I know I'm going through things relatively quickly, but what we've done here is now we are jumping into our final DuPont identity, which says that ROE can be broken down into net income over net sales multiplied by net sales over total assets multiplied by total assets over total equity. So let me just showcase what we've done here. The first step that we did was we took ROE and said that it is a product of a company's ROA and their equity multiplier. And then what we did is we looked at ROA and broke that down into profit margin and total asset turnover. And so the final step of the DuPont says that ROE is broken down into profit margin, total asset turnover, and the equity multiplier. So what do these three different ratios showcase? Well, net profit margin measures the firm's operating efficiency, so focusing on expense management. Total asset turnover focuses on asset management, so measures the firm's asset use efficiency. And then the equity multiplier is a leverage ratio, so focusing on debt management. So the key takeaway here, and this is your full DuPont identity, ROE is equal to profit margin times total asset turnover times equity multiplier. And what I've showcased up here is we had three different steps to the DuPont to come up with that DuPont identity. Step one was to say that ROE was equal to ROA times equity multiplier. Step two was to break down ROA to be the profit margin times total asset turnover. And then step three is to throw it all together. But what is nice about the DuPont identity is that you can look at a company's ROE and really break it down and see that the main driver is their expense management, so profit margins, their ability to manage their expenses on their income statement to generate net income, total asset turnover, their ability to generate sales from their asset investment, and then your debt management is the amount of debt in your capital structure. So you're able to look at a company's operations and focus on what the main drivers are. Is it expenses? Is it asset management? Is it debt management? And you can do so by utilizing the DuPont. So here's just an extended DuPont chart where our bottom line, our final value, is focusing on ROE. We first broke it down into ROA times the equity multiplier, and then we can break it ROA down into profit margin and total asset turnover, and then we can look at the different components of these different ratios and try to identify which of these areas is impacting this bottom line of return on equity the most. So here we just have a quick little analysis of Yahoo versus Alphabet from 2013 to 2015. You can see that with Yahoo in particular, their ROE substantially decreased from 2013 to 2015. Utilizing the DuPont, you can see that the main driver was profit margin. So their profit margin, their ability to manage their expenses to generate net income, actually went negative in 2015, and so you could turn your focus towards the expense management in that particular 2014 to 2015 year and try to identify what was going on in their operations with their expenses that resulted in this negative ROE. So their total asset turnover actually increased from 2014 to 2015, generated more sales from their asset base. Their amount of leverage stayed about the same. So the main driver was this profit margin, and it will allow you as an analyst to turn your attention to their expense management to try to identify what was going on that had that substantial impact. So that's the main thing with the DuPont is look at a company's ROE, try to identify what the main drivers are. Is it expense management? Is it asset management? Or is it debt management? And you can then turn your focus to that area as you are doing your analysis. So our extra material here towards the end is focusing as this ROE as a goal. In Chapter 1, we said the goal of financial management was to maximize shareholders' wealth, so maximize the stock price. Why does the DuPont then focus on maximizing ROE and identifying its main drivers? Well, those who believe that maximizing ROE is the same as maximizing shareholders' value or maximizing stock price will argue that ROE allows management to break down the performance and identify areas of strengths and weaknesses, whether it be with expense management, asset management, or debt management. And ROE is also highly correlated with shareholder wealth maximization. So ROE is highly correlated with increases in stock price. Those who do not agree that they are the same identify three key weaknesses. One is that ROE is based on after-tax earnings, not cash flows. So it's focusing on net income, which is an after-tax earning. We said at the very beginning that we want to maximize cash flows. So that's one of the key arguments against maximizing ROE in comparison to maximizing share price. ROE does not consider the risk of any of these investments that are generating the net income. So what is the risk of the cash flows? And then it also ignores the size of the initial investment as well as all future cash flows. So the big thing here, the key takeaway, is that with this ROE maximization, we are not considering cash flows. And from the very beginning, we have discussed that the value or the way that you maximize shareholders' wealth is to maximize the stock price. How do you maximize the stock price? Essentially, you are maximizing cash flows. So we have two more ratios before we conclude. The thing with these two more ratios is you need to ask yourself, what can a company do with their net income? So their bottom line on their income statement. Well, you should know that they can either pay it out in the form of a dividend or they can have an addition to their retained earnings. These two ratios just showcase what percentage of their net income goes out in the form of dividends and what percentage of their net income is put back into the company in the form of retained earnings. So hopefully you realize that if the company pays out 30% of their net income in the form of dividends, that means they put back in 70%. These two ratios must always add up to 100%. And so the final statement here, the final slide, why evaluate financial statements for internal uses? They help with performance evaluation, so you can tie compensation packages to this ratio analysis or evaluation, and you can also use this to compare between divisions to identify those divisions that are most profitable or struggling the most. And then we also have planning for the future. These can be used as a guide in estimating future cash flows. Externally, creditors, suppliers, customers, stockholders are all using these financial statements to evaluate the financial health and identify those companies that they would like to invest in or loan to and so forth. So that concludes part 1 of chapter 3. I know we've gone through a lot of material. Hopefully you were able to follow along and take some good notes on the chapter 3 outline. And what we'll do in part 2 then is work through some practice problems that are similar to the types of problems that you can find in your chapter 3 homework and eventually then our first exam. So good luck. Email me if you have any questions, and I will talk to you all soon. Thanks.